Good afternoon to our CLA family, clients, community partners, and friends, and welcome back to our live stream. We're so grateful to have you here with us, and as always, your health and safety is our number one priority. Today, we'll be focusing on a market and economic update after we get the latest on PPP loan forgiveness. I want to start today's session with a couple of quick housekeeping items. We want you to ask questions and be a part of the conversation with us again today. We have professionals in the chat eager to respond to your questions during today's session. And then, of course, as always, following the session, you can visit us on claconnect.com on our COVID hub and contact us through the button there. Today, like last Thursday, we're going to pivot at the end of the session and turn the conversation to you so that you can ask the experts and the people presenting the good questions that you have coming, and I can direct them and you can get a live response from them. So please stay with us, keep those questions coming, and know that if we don't answer you in the chat, we'll be talking to you during the stream. We're going to start back with Jack Rybicki to talk to us about a few of the PPP updates. Welcome back, Jack.
Hi, Jen. Nice to see you again.
Nice to see you too. Jack, can you give us some updates about the frequently asked questions that have been released in the last few days, as well as some of the safe harbor extension?
Yeah, sure. So there hasn't been a ton of activity, but we have gotten some information. First of all, the SBA released the results through May 1st of the program itself. And so of the $310 billion additional allocation, about $176 billion has already been accounted for. And this was through May 1st. Interestingly enough, though, the loan size has been driven down fairly dramatically, where it was a little over 200,000 in the first tranche. Now it's down to about 79,000 through the May time or the May 1st time frame. So we're seeing a heavier volume of smaller loans, and in fact, nearly 1.6 million of the loans that were approved in the second round here were below $50,000. So we really do think that this is starting to get to the intended group of folks, the small businesses that are out there that really were getting targeted by this. In terms of FAQs that have come out, there were 5 that came out over the last week or so, and I'm going to focus really on 3 or 4 of those. Some of them are very narrowly focused. But the main one that everybody was hotly waiting for and finally did come out just a couple days ago was FAQ 43. What this did is it extended the safe harbor date, right? So the date of May 7th was looming large for everybody to make a decision on whether or not they felt they were eligible and if they had to return the funds or not. We did get a little bit of relief on that, and Treasury did extend that date to May 14th. And they've assured us that they're going to provide some guidance around the whole economic uncertainty criteria and what they meant by that. So more to come on that for sure next week. We'll see what the guidance looks like there. There were a couple other things that also, one that helped folks out and another that maybe threw us into a little bit of a turmoil. FAQ 40 came out, and it really, the question there that it was trying to answer was, what if I, as a business owner, I tried to hire people back, but I couldn't? They didn't want to come back for whatever reason. And it did give borrowers a bit of relief and said that if you provided a written offer to somebody and they rejected that offer, that you've met your obligation to try to rehire those folks. And so they won't count against you from an FTE test or the payroll test. So that was a positive thing that came out. One that was a bit negative, ultimately, and it's because it introduced some ambiguity, was the one that was introduced yesterday, the FAQ 44. We hope that the spirit of that was really just to make sure everybody understood that you had to consider both U.S. affiliates and foreign affiliates when you've got an owner that is a foreign parent that has foreign affiliated companies. However, when they introduced that new language, one of the key factors around the employee count, which is employees are folks that are residents of the United States, that's what needed to be considered, was excluded from FAQ 44. We don't know if this was just poor drafting or if that was intent, that they're signaling that you have to consider all employees, not just the US based employees of foreign affiliates. So a big concern there, a new ambiguity that was introduced obviously very late in the game. So those are a couple things that came out in the FAQs that last one in particular raises some concern. There were a couple interim final rules, so additional guidance that came out. One in particular I want to cover that does talk about limitations on the loans. There were a number of companies that came out that because of the things like hotels and restaurants and other things not being subject to the affiliate rules, we heard a lot about companies that got in the aggregate 50, 60, $100 million of PPP loans because they were able to apply on an entity by entity basis. In the one IFR that did come out, they basically said at a corporate level, you can't get more than 20 million of PPP loans. So even though the underlying entities in a hotel or a restaurant chain might be eligible for in excess of that, at the corporate level, you'll have to govern yourself and only take a maximum of $20 million of loans under the PPP program. So those were really the big things that came out that weren't very specific in nature. Nonprofit hospitals, there was some guidance out for you. For small colleges and universities that have a lot of work study students, there was some guidance out for you. So make sure you're paying attention to that on the Treasury website. But the ones that were broad-based in their applicability, I went through. So thanks, Jen, and that's all we got for you right now.
Excellent, Jack. Thank you so much. I know that the chat is kind of hopping with questions here for you. So if you could please stick around for the end, and then pivot back to the audience, we'd really appreciate it. But for now, I'd like to just transition to our key topic of today. We're thrilled to have Clayton Bland, who is CLA's Chief Wealth Advisor, and Brian Ream, who's a principal in our Wealth Advisory Group, with us to give us a market update and talk about the tax and wealth advisory strategies for the remainder of 2020. The global pandemic has certainly affected financial markets and investors all over the world, so we're really excited to have you guys here to kind of help talk us through it. So welcome, Clayton and Brian.
Thanks, Jen. Happy to be here.
Thanks so much. So Clayton, why don't we start with you and just ask, the really broad question, which is, what is your message right now as you're talking to your clients?
So thanks, Jen. So the message has been pretty consistent over the last few months. Initially, it has centered around trying to give clients appropriate perspective and certainly trying to provide people with thoughtful action and things that they could essentially do that would not be emotional decisions, but really based on, okay, what's really happening? So today, one of the challenges that we face is clients are asking the question of what is happening with the market, given that the economy looks so bad. So what does that mean specifically? Tomorrow, we've got the Bureau of Labor Statistics that's going to come out with the April jobs number. That data the consensus is 22 million jobs that will be lost. In March, you had 700,000. And you start hearing numbers like that. There is nothing that has ever happened like that in the history of really ever in this economy. And so when things appear so bleak and you're seeing information like that, and that ties into the Paycheck Protection Program that Jack was talking about and all the measures that from a fiscal relief program standpoint are trying to help, it's very hard to understand, well, why is the market continuing to recover and go back up? And even today, the NASDAQ is actually positive for the year. So a lot of our conversation is really trying to help clients understand what's happening and why.
Okay. And that makes a lot of sense. And, I've heard you two talk about sort of what's happening in a three-phase approach. Brian, could you maybe talk to us about what you mean by that and bring everybody else up to speed on that?
Yeah, I think it's important to set the context for clients as we deal with our investors. I mean, there's really, from crisis to resolution, you really typically run through three phases. The first phase is almost always event-driven. In this case, it was the pandemic running from approximately mid to late February through March 23rd. We had the precipitous decline. It was a pretty much wholesale sell-all type of environment. But then we reached this inflection point on February 23rd when the Fed really came in with substantial firepower and kind of shifted the narrative, and we pivoted. Really started to pivot into phase two, which now we're pretty much still in, but it's really an assessment phase. What damage did we incur? And we're starting to see these numbers come in now. Clayton alluded to the unemployment numbers. We can look at GDP numbers, and it's a period marked by a lot of questions, a lot of conjecture, and a lot of uncertainty about what happens next.
Okay, that makes a lot of sense. So it sounds like we're kind of through the first phase and sort of right in the heart of what's going on next.
Yeah.
Clayton, maybe could you talk to us a little bit about how this moment is different from previous financial downturns?
Yeah, I think to provide some perspective, a lot of people are looking back to the 2008 financial crisis, and you can go back to 1999, 2000. What's challenging here is that the scope of this decline and this shock to the economy is certainly the swiftness of how it's occurred is unlike anything we've ever seen. And the effect on the decline in GDP in 2020 relative to the previous year, it's really one of these situations that is a tremendous shock. I mean, we're obviously talking about job losses being unprecedented, something that we've never experienced before. You've got industries that are at a complete standstill. And unlike a lot of economic cycles, you can have certain particular industries, maybe particular regions or countries that are affected in this downturn. In this situation, it's global, and you're having a complete shutdown across the board. Certain industries are obviously worse than others, but to give it some perspective, in 2008, that decline in GDP year over year was approximately 50% decline. And one of the challenges is looking at in this time period in 2020 relative to 2019, what is that drawdown in GDP? And the estimates have ranged originally talking about a 15 to 20% decline in GDP. It's certainly you're seeing some estimates where it's as much as 40%. I'd say the key difference that Wall Street and I think people are looking to is what's the recovery period in this downturn relative to 2008? So 2008 took approximately 4 years to get back to that GDP growth level. And in this downturn, the base case scenario is really people are expecting that it should be faster. Is it going to be 24 months? Is it 18 months? But certainly the amount of fiscal relief and monetary stimulus is certainly providing a lot of that impetus as to why this might be a swifter recovery. And let me just give a couple examples.
Sure.
In 2008, Jen, when we had the initial downturn, the financial crisis, and the financial system really under severe pressure, the Fed instituted quantitative easing 1. So Treasury starts printing money. The Fed is going out into the marketplace and buying up assets. At that time, a lot of mortgage-backed securities.
Right.
That initial round of quantitative easing was approximately $80 billion a month that was coming into the system. So a lot of people remember you're talking about inflation was going to occur, your printing presses are on, and you're going out and Fed's coming in to try and support the economy. Today, which we're on quantitative easing 4, the volume of liquidity that's coming from the Fed is $80 billion a day.
Wow.
So it is dramatically a much more aggressive response. And a couple other ways to kind of look at this in perspective. It was just announced this week on new Treasury issuance. So that means Treasury is going to go out and sell Treasury bonds to raise money. They announced approximately $3 trillion of new Treasuries are going to be issued in the second quarter of 2020. That's in addition to the $1.5 trillion that has already been issued this year. It is almost 3.5 times more Treasuries issued than all of last year. So that combination of monetary stimulus of coming into the system and what's truly from a very unprecedented fiscal stimulus of all these relief packages is really one of the key differentiators that people are looking to, as that is this massive amount of support that most everyone agrees is absolutely necessary, but it is certainly providing that optimism that maybe this recovery and maybe what we can come out of this will end up being okay.
Yeah.
That's really helpful.
Yeah.
Brian, do you have some comments on this as well?
Yeah, I think that investors have what they call a recency bias. It's I'm going to relate this event, my current environment, with what happened most recently. And in the past, 2008 was that decline. But trying to connect those dots, I mean, those are very tenuous connections. 2008, we went into that global financial crisis, highly leveraged. People were using their homes as piggy banks. We had ninja loans, where basically if you could fog a mirror, you got a mortgage. The connections aren't there. 2019 economy, we were running really in a Goldilocks scenario. Employment or unemployment was just right. We were basically at a state of full employment. And I think the key difference, and Clayton's alluding to it, 2008 financial crisis, the Fed moved with a very cautious, kind of tepid manner. 2019, and as we moved into 20, the actions the Fed has taken this year have been full of firepower. So, there's the old saying is, you don't bring a knife to a gunfight. And as things started to deteriorate, and this became a gunfight by mid-February, the Fed really rolled out the cannon, and this was a full-blown cannon blast, leaving really no uncertainty that they weren't going to be there to backstop the economy.
Yeah, absolutely. And it's nice. Clayton talked somewhat about what specifically the Fed was doing. I think you guys alluded in one of our conversations that Warren Buffett said, look, the market is saying that the Fed is doing whatever it takes squared. I heard you say, and I think that exponential response is helpful. Do you guys want to talk a little bit about how that's going to affect the individual investors?
It's a good question, Jen. So let's get a little specific on what we mean by this quantitative easing. So the Federal Reserve, when they are getting this printed money from the Treasury, they are going out and buying all various types of assets. So traditionally, it would be coming out to stimulate and pump money into the system by buying treasuries, by buying mortgage-backed securities, really stabilizing key parts of the economy. And mortgage-backed securities would be, Fannie Mae, Freddie Mac, various types of collateralized and securitized mortgage securities. What's happening is they are actively in the marketplace buying all sorts of assets. They're buying corporate bonds to stabilize the corporate bond market. They're buying municipal bonds to stabilize that market. And when I say stabilize it, it's really from a liquidity crunch. If you've got panic and people are selling these assets to raise cash, they are stepping in to provide that market and that liquidity. They've even gone so far to step in and say, okay, well, what other ways can we provide that stimulus? And they've gone in and purchased exchange traded funds, ETFs. So individual investors who may have owned an underlying security of an exchange traded fund that was comprised of either stocks or corporate bonds, we saw significant moves in prices of those securities, really not because the underlying assets were defaulting or showing weakness, but just from a pure liquidity standpoint of a mass selling. And so there's talk of the Fed even stepping in to stabilize and start purchasing high yield securities. So how does that help the individual investor? It really is this reassurance that the belief is that this downturn in the economy and this is, again, as I mentioned earlier, it's not just a US problem. So in Europe, you've got the European Central Bank doing the same thing, pumping money into the system, going in and buying these various assets. The other large central bank globally is the Japanese Central Bank. So they've been stepping in doing the same thing. And in large part, we've had a decade of central bank monetary policy stepping in to provide excess liquidity and support. And I'll make one additional comment, maybe we can expand on further, is if you think back to 8 years ago when the Fed was stepping in and doing this action, the immediate kind of default assumption was, well, what's the effect of taking on all this excess debt and all this money coming into the system? The reaction was, it's generally presumed to be inflationary, that we're going to have either rising costs of goods or diminishing purchasing power of our currency. And there's a few unique things about this situation that I think make this a very unpredictable environment as to what's going to happen.
So as we look forward and we see all the volatility, who should we be listening to through all of this?
Well, that's a really good question. As I said, as we're kind of in the heat of phase 2 right now, there is a tremendous amount of uncertainty and speculation. And really the only thing that's certain right now is all of our traditional measuring tools, the valuation metrics for companies, commodities, economies have really been kind of tossed aside. We don't have a meaningful way to build in what could happen into present values. So, the result of that is we have conjecture that is kind of bleeding through the media right now. One thing that's for certain, we don't know what comes next. There was a say that there's a light at the end of the tunnel. Is it an oncoming train? Is that represented by a mutation in the virus and a second wave? Or is it Regeneron or any of the numerous, I think there are currently 8 vaccine trials under human testing right now. We're not sure. Nobody knows. So we're encouraging everybody, take a step back, take a breather, turn off the TV. What we do know is that this will run its course, and investors need to remain focused on the long-term goals, their long-term plans, and the things we preach all the time: rebalance and take advantage of this. Downturns in the market aren't necessarily and don't have to be a bad thing. A lot of times that's an opportunity to come back, reset, refocus, and as I said, rebalance your portfolio.
And Brian, that's the perfect lead into kind of the next question that I really want to focus on for just a few minutes here, which is I want to ask you guys, what are some specific actions we can take to help weather this time?
So Jen, I think as Brian kind of alluded to this, if we look at what should we be doing and who should we be listening to, I think there's a good way to characterize it would be constructive optimism. Okay. The fact is, we know right now how bad things are. When I talked about earlier, a jobs number that's going to come out with 22 million jobs lost in a month. To put it in perspective, throughout the entire recovery from the financial crisis over that 10-year period, the economy was adding 185, 200,000 jobs a month, which was great growth of new job creation. We've effectively lost all of those jobs that were created in 10 years in 1 month. So how does that, that sounds awful, and you can sit here and say we're headed for a depression. Those are depression type of numbers, but being constructively optimistic with the things we talked about of ways to stimulate, to provide some stimulus that can actually get us growing again, we think it's really important to focus on key strategies of things that you can do now. That in large part here at CLA, what we're talking about is, are there tax strategies that can be implemented due to change in legislation with the CARES Act? Are there things that can be done as asset prices are lower? So as a couple examples, you could look at potential Roth IRA conversions. Is this a year for the creation of a family foundation and making large charitable contributions to offset other forms of income? There are some unique provisions in the tax law that are worth exploring from realizing losses. There are a number of things when you start thinking about what really ultimately is important in our lives from a family planning and estate planning standpoint. When you start thinking about mortality and volatility and things that we're faced with today, do clients have those types of things in order? And have they really gone through thinking about, how do I structure a lot of my assets and my planning for that next generation? And elaborating a little bit more, there's a number of our clients here at CLA that are privately held business owners that in the next few years, some succession planning is top of mind, and starting to think through, gosh, are those things that we can really be focusing on and start making progress there. So those are some of the broad topics. As it pertains to individual investments and portfolios, I just would want to highlight, and I think Brian did a good job of this, of talking about where are we with this phase. And we talked about a base case scenario of looking at, well, the stimulus from the Fed. You've got relief that is fiscal policy. Are we on this track to get full recovery very quickly? Most likely not. It's going to take a while, and there could be, and there most certainly will be, more volatility. So a focus on high quality investments and really looking to reposition and say, okay, when can I be opportunistic? We're not in the camp of saying, yeah, now is the time to go all in, adding risk, making big bets. We are advising clients that this is the time to really reevaluate where can I focus high quality investments in both U.S. dividend paying stocks and in high quality real estate. And then we could talk a little bit more if maybe we get some questions. But when you look at the expected potential inflation or diminishing purchasing power of our currency with all this stimulus, there are certain asset classes that we think could bode well over the next decade. And I think CLA has a platform to really serve those needs.
Yeah, I would very much agree with that. As you mentioned, questions from the audience. As promised, I am going to shift the conversation, kind of turn the camera back to them, just so that we can pull some of that in, because I think your comments have really spurred some good questions here. So we'll start with one on the wealth advisory side. One of the questions that I see is how should future inflation influence our investments?
Well, it's a great question, Jen. So this is a little bit of the challenge. Inflation is really, as I mentioned, let's call it diminishing purchasing power of the dollar. So here in the U.S., does it mean for every dollar that you have, are you able to buy less goods? Mm-hmm. That's definitely relative, generally speaking, to other currencies, right? The purchasing power of the dollar relative to the euro or other currencies. In the world we live in, all currencies effectively are being stimulated and money is being printed. So what really matters here is how are clients ultimately going to get a rate of return in a low growth environment? And when we talk about high quality investments, our focus, and one of the things that we've been focused on at CLA for over the last decade, is incorporating a big part of clients' portfolios in real estate. And in our platform for over a decade, we have approximately 25% of our clients' assets in private real estate. And it's a platform we've grown over the last decade. So to answer the question specifically, I think it's certainly an element of high quality U.S. companies that can maintain steady earnings and a form of returning capital back to shareholders through dividends. And in an inflationary environment, you have to maintain some form of growth. So operating businesses that can grow is absolutely necessary. And owning real estate that is generating rental income that can really provide clients with the opportunity for increased in rent and rental income growth, and the combination of that appreciation of the underlying property and the asset. That is certainly in both categories there, maintaining a high quality approach. We think that is a way to respond and look to be an investor in a potentially inflationary environment.
Yeah.
Thank you so much.
I would just add quickly, if I could. Right now, if you look at what the drivers are for inflation, it's typically tight labor markets and tight or high commodity prices. Expected number out tomorrow is that we're going to go from 4.5% unemployment to about 16% unemployment. So we're not seeing any tightness in the labor markets. Probably, we've seen the price of oil decline precipitously as well. So I would go ahead and speculate that inflation is going to be a problem for a much further out future date. Really nothing on the horizon right now.
Excellent. That makes sense. It really does. And not to be abrupt, but I do want to pivot back to some of these questions that we're getting on the PPP just before we close out. Jack, there's one here from Nellie just asking, is there a way to contact the SBA directly so that I can find out whether simply having a large available line of credit makes us ineligible to keep our PPP funds? Could you answer?
Yeah, I mean, there is an SBA help desk, but I will tell you the help desk is manned by junior SBA people. And, while we've reached out to them on topics in the past, very rarely will they give you anything definitive, and definitely nothing that you can hang your hat on. So you might be able to get something for them that says, oh, yeah, it's okay if you have that. It's not going to count against you. An SBA reviewer on the back end, though, is not going to rely on that and say, okay, it was okay because you got that. So unfortunately, until Treasury comes out with an FAQ or something gets memorialized in an interim final rule, there's really nothing you can do. And we don't expect any bright line tests to come out, unfortunately, on that topic.
Okay, that's good to know. And I guess are you going to be, Jack, able to talk to more of this probably on Tuesday next week on the live stream, just to bring back and kind of wrap up any more guidance that we have, or any more direction for people as they get closer to that May 14th deadline?
Yeah, I mean, look, we hope, right? Treasury said that they're going to have some more guidance out in advance of the 14th deadline. We hope that doesn't mean the morning of the 14th or the night of the 13th. So hopefully by Tuesday next week, we will have something to talk about in that vein. Excellent.
Well, you guys, I hate to wrap this up actually, because it has been such an informative and dynamic dialogue that I can't tell you how much I know I appreciate it, and our audience appreciates your time today. So thank you, Clayton, Brian, and Jack. Really appreciate your time. Moderators in the audience, thank you so much for the great dialogue in the chat. Please join us next Tuesday for more information about where things stand and what we need to know related to PPP and any new legislation, along with other topics that you bring to us that really have relevance for you. If you have questions, please visit our COVID landing page at claconnect.com, and we'll get you to the right person to help you. We also update that frequently with articles, blogs, and other releases about what's going on. So until next week, please stay healthy and safe, and thank you for joining us today.
Thanks, Jen.